Hello investors, welcome to Proximo, the Value Stock Analyzer. Today we are going to take another cold look at a new stock that we haven't analyzed before, Troika Media Group. If you like this style of video, please give us a like and subscribe. Your subscriptions mean a lot to us and the channel. So what is Troika Media Group? I hadn't heard about them until earlier this week. If we come over here to the About page, Troika Media Group operates as a brand consulting and marketing agency specializing in entertainment and sports media sectors worldwide. It offers media services and analytics platform, digital marketing, data analytics, reporting, media content for events and hospitality, customers, sponsorship, partnerships, advertising opportunities, analytics, and big data, strategic media buying and planning, design and branding, market research and insights, brand strategy, 360 brand design, advertising and sponsorship, integration, brand experience and fan engagement, content creation, sonic branding, original music services, as well as design, animation, and post-production studio services. A lot there. A lot there. It serves fashion, beauty, jewelry, watches, beverage, alcohol, pharmaceuticals, entertainment, consumer goods, telco, tech, sports, automotive industries, as well as nonprofit organizations. The company was formerly known as M2 Engage Group and changed its name to Troika Media Group in July 2017. And we can see that their IPO date was 4/16/21. HQLA with 208 employees. Cool. So if we come back to our fundamentals, we can see Troika Media Group is trading at 27 cents. We can see they are not profitable. We have a negative EPS and we have a 0 price to earnings ratio. So this means that they're not a profitable company. We have a 52-week low of 10 cents and a 52-week high of $1.42. So that's a pretty big swing right there. And then a market cap of $92.07 million. If we take a look at revenue by segments, they are making most of their revenue in hospitality with 14.6% in residential. Coming down here, we can see that price history. So it looks like this time last year, they were trading just about over $1. They had a big dip. They had a nice little comeback. And since then, steadily down until recently when they went up to 77 cents and now back down to 27, which is probably why it's been trending and why we're covering it here at Proximo. Coming down to year-over-year revenue growth, it looks like their last annual reportings was on September for 2022, where they reported revenue of $116.41 million, a growth of 618%. Previous year, they only did revenues of $16.19 million. Before that, 24, and before that, 40. So yeah, this to me says that they're very much kind of a startup. They probably have a lot of interesting contracts that swing the books one way or another. Last year, it looks like they had some really great new contracts and new customers to get that revenue up. That or potentially some acquisition or merger where they were able to increase those revenues so much. But this also tells me that they're, if we go back up, actually, we could see that market cap is 92 million. Last year's revenue is 116 million. Usually when revenue exceeds market cap like that, this tells us that, well, we know they're not profitable, but they probably have profitability problems, right? They're probably struggling to get into profitability. Otherwise, the stock price would be a lot higher right now. Coming down here to earnings, we can see total net income for last year when they did 116 million was negative 38.69 million, which is a pretty big proportion to their revenue, right? When we have total net income this high relative to that total revenue, they are pretty far from profitability. But it is still an increase. It is better though. So if we look at 116 million in revenue versus minus 38 million in total net income. The previous year was 16 million in revenue with negative 16 million in total net income. The ratio between revenue and net income is better than it was the previous year. Let's take a look at the income statement. So if we look at things quarterly, the last reported quarter was November 14th when they brought in 119 million.81. So that's actually impressive. So if we look, these 4 quarters here, 8.3, 6.9, 15.69, and 85.38, these are the 4 quarters that made up the previous annual income that we were looking at on the fundamentals page. And then the first quarter of the new year, 119 million. They're off to a better start already. And actually, if we come down here to net income on this $119 million quarter, they have a positive net income. So that's super interesting. It looks like they are maybe starting to get into that profitability land. So 1.27 million net income on 119 million in revenue. That is a positive, that is a move in a positive direction, I would say, for Troika Media Group. Let's take a look at the balance sheet also and see what their cash position looks like. Cash and cash equivalents, 32.67 million on the last reported date. Same the quarter before that, 42 million the quarter before that. And then looks like things dropped quite a bit, 5, 9, 12, and 1.43. So they have increased their cash position. It looks like it's a little bit of a roller coaster. I wonder if there's some debt involved here, or what we've also seen in a lot of other stocks, stock dilution, which could explain the drop in stock price also. We'll take a look at that in just a little bit. Their total assets have been rising from 4.82 million to 72.58 million. Also a little bit of a roller coaster. It looks like something happened between this reporting period and this reporting period, because they went from 75 down to 66 and now slowly back up to 72. Let's take a look at institutional ownership. At the most recent quarter, there's a 4.75% institutional ownership versus the same period last year, 2.77. If we take a look at who those institutional owners are, Altium, Hightower, SG3 Management. So not a ton of institutional ownership, but we say, that's institutional ownership is a little bit of a double-edged sword. If there is a lot of institutional ownership, it can be said that there's probably not as much growth in it, but there's a lot of confidence in the stock. Versus if there's not a lot of institutional ownership, there is potentially a lot of growth left in the stock. For something that's trading at 27 cents, there's either a lot of growth left in this stock or a delisting or acquisition in its future. So how would I summarize Troika Media Group based on this first glance? They look like a young company with a lot of potential that needs to probably figure out profitability. I think there's still a lot more I need to do research on. Like I always say, the numbers are really only half the story. The other half is the company themselves, what they're invested in, what their future prospects look like. And we can't see that just from looking at the technical analysis. So over the next couple of weeks, we'll continue research on Troika Media Group like we have for other stocks to see what that other half of the story is and see whether this is something worth investing in or worth passing on. That's it for today. Thank you for listening. Please give us a like and subscribe, and we'll see you in the next video. Go find some value.